Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about deferred taxes, and we've covered a lot of information. We've talked about why it's important to account for taxes. We've talked about how it affects the financial statements, what's required in the financial statements by FASB. We've talked about deferred taxes. We've talked about temporary differences, permanent differences, calculations, steps, NOLs, all sorts of stuff that helps us pull together and provide our investors with the best information about taxes we can. Now it's time to pull it all together in one comprehensive example. And the way we're going to do this is we're going to work through one of these years together, and then I'm going to let you work on a couple yourself and then come back and we'll give you some check figures. So let's jump right into this with our example of First Place Incorporated, and you'll see the details of First Place right up here. So First Place Incorporated was incorporated in year one. For the first 5 years of the company's life, it reported income before taxes of $100,000. And I did that just to keep it simple. We've done income before tax calculations many times in the past, so there's no reason to go over it again. The GAAP numbers that are included in this income before taxes number are $120,000 of straight line depreciation each year, $500 of life insurance premiums each year, warranty expense for each of the first 4 years, and $25,000 of rent revenue that occurred in year 4 and year 5. The tax accountant has gone back through our numbers, and she has provided us information about taxable income that's a little bit different than the GAAP numbers that we've already seen. So first off, from the makers tables, depreciation will be $150 in year 1, $228 in year 2, $222 in year 3, and then it will be done. Warranty outlays, the actual cash paid or inventory given to satisfy warranty expenses, will be $10,000 in year 1, $19 in year 2, $20 in year 3, $21 in year 4, and $10,000 in year 5. And finally, the last difference is that all of that rent revenue will be received in year 4. So they have prepaid for the 2 years of rent. Tax rate for First Place has changed a little bit. It was 40% in year 1. It'll drop to 38% in year 2, 36% in year 3, and then 34% in years 4 and 5. We want to prepare the journal entries to record our income tax expense and deferred tax liability for each of these years. One little caveat here, I think we'll probably keep this to just the first 4 years for the sake of time. That should give us plenty of practice, but also maybe help to shorten this series of segments just a little bit. We're already going kind of long on our deferred taxes, so it might be nice to keep it down a little bit. If you do want to see the year 5 numbers, please let me know. I'll be happy to provide them later, but for now, let's just focus on the first 4 years. And to help us do that, I've got an Excel template ready to go. If you are doing this with me in class, you should have access to a template that you can use and convert, so you're ready to jump right into this. If you're doing it on your own, or if you just prefer to use your own work, basically this template looks just like what we've been doing in our earlier examples. We'll just use that as the basis and beef it up to meet the multiple examples that are available here. So let's switch over to Excel. We're going to start with income before taxes, and we don't have a revenue and expense number. What we have is the total number. So I'm just going to type that in. We were told it was $100,000. The company has one permanent difference. Did you notice what it was? Well, in order to know for sure, we've got to go back and check something. First off, we know that life insurance premiums are permanent differences. So since I've already told you there's just one difference, you know that's it. But the other thing we do need to check is we do need to make sure that the others are really temporary differences and not permanent differences. So to do that, we take 120,000 times 5, and that gives us $600,000. We then add up the 150, the 228, the 222. Sure enough, that comes out to $600,000. So we're okay. Our depreciation is just a timing difference, not a permanent difference. If you do the same thing with the warranty outlays, it was $20,000 a year for 4 years. That's $80,000. If you add the 10 plus the 19 plus the 20 plus the 21 plus the 10, you also get $80,000. So again, that's a temporary difference as well, because the amounts match up. It's just the timing that's different. And for the rent revenue, we get $25,000 in year 4 to cover year 4 and 5. The only difference is that I'm going to record all the rent revenue in year 4 for taxes. I'm going to split it in half for GAAP. So again, that's a temporary difference as well. So really, we have only one permanent difference, and it's that $500 of life insurance premiums. So life insurance premiums. Now we've done this adjustment before for life insurance payouts. This is a life insurance premium. So they're not paying us, we're paying them. And as always, to determine the sign of this adjustment, we're going to draw it out. For GAAP, I'm showing insurance expense of $500 a year. So that's a negative number. For tax, I can't get a deduction for that 500. So the number is 0. So I'm going from a negative 500 to 0. That's a $500 adjustment, and it is positive. So that's what we'll put into our spreadsheet, is a positive 500, because I'm not getting that break. Next, we need to look at our temporary differences. Now I've got 2 lines here because that's what we were using in example 2, and that's where I pulled this template from. But we need to look at our numbers and see what adjustments we need to make. So let's see here. We have depreciation each year, and it's different between year 1 GAAP and year 1 tax. We've taken care of the insurance. The warranty was for each of the first 4 years, and we've got numbers for that for years 1, 2, 3, 4, and 5. So that's an adjustment we need to take care of now in year 1. The rent revenue isn't going to happen until years 4 and 5. So for now, we're only concerned with the depreciation and the warranty. Let's go ahead and figure out the sign of these adjustments. We'll do it the same way we just did for the permanent difference and the way we've done in the past. So for year 1, we're going to start GAAP for depreciation. Let's put this up here. This is depreciation. So GAAP depreciation was $120,000. It's a negative because it's depreciation. Tax was $150,000. So that's down here. So to go from GAAP to tax, I need to drop the value $30,000. So I need a negative adjustment. And I'm going to put that in right here. This is a difference in depreciation. And we said it was a negative $30,000. The next one we said was the warranty. And again, we'll start with GAAP. So for GAAP purposes, we had warranty expense of $20,000. For taxes, we can only count warranty expense if we actually paid out, and we only paid out $10,000. So to go from GAAP to tax, I need a $10,000 increase this time because I didn't get as much of a discount under tax as I did under GAAP. So we'll put in, this is a difference in warranty expense, and it's a positive $10,000. So overall, taxable income is $80,500 as opposed to book taxable income, which is $100,500. And we'll just stop right there. Since book taxable income is bigger than taxable income, this should come out to be a, hopefully you said deferred tax liability, because that's what we're looking for. When tax is lower than GAAP because of temporary differences, we're going to have to make up that tax break later on. That means we've got a liability. So this has got to come out to a liability later on. Our tax rate for this year is 40%. So our taxes payable for year 1 will be $32,200. Now for step 5, we're going to use the exact same process as we've done in the past. The only difference is you need to add 2 more years. So let me see if I can copy this across. So I've got year 2, year 3, year 4, and year 5. And I need to replace the values and the percentages. And let's see, this is not going to be revenues. This is going to be for depreciation. And we'll do the warranties in just a minute. Now, the rule here is that we need 1 table in step 5 for every adjustment in step 3. So we'll start with depreciation, but we'll add a warranty in just a bit. Now, for GAAP purposes, we have depreciation of $120,000 every year for the first 5 years. Now, we've already taken care of year 1, so we're just looking at the future, 2, 3, 4, and 5. For tax purposes, in year 4, we have $228 and $222, and then it will be 0 in future years. Copy this across. There's our differences in revenues. Excuse me, not in revenues. I need to fix that too. This is our difference in depreciation. Our enacted tax rate, it's 40% this year. It's going to drop to 38, 36, 34, and 34. So our net effect for depreciation, once I get my equations all in here, there we go, will be a credit of 38.40. Now we have to do this again because we have two adjustments up above, so we'll need two tables down below. So I'm going to just copy this and insert the cells. And then I'll change this. This is, instead of depreciation, it's warranty. And instead of tax depreciation, it'll be warranty. Again, we're going to use the numbers given to us in the slide. So for GAAP, it was $20,000 a year through year 4. So 0 in year 5. For taxes, what we actually pay out, so $19,000 in year 2, $20,000 in year 3, $21,000 in year 4, and $10,000 in year 5. And if you look up here, the warranty expense actually increased my taxable income, which means I'm paying more than I think I should, which gives me a deferred tax asset. So we have a deferred tax liability here and a deferred tax asset down here with our two adjustments, depreciation and warranty. Now the last thing we need is a sum. So I'm going to add a couple of rows. And right here, we're going to calculate net deferred taxes. I'm going to bold that just so it's easy to find. I'm going to make this equal to the two total values. So overall, I want a liability, which is what I said I wanted, for $480. So in my deferred tax account, I want a credit. Again, I'm going to make that a permanent reference so I can copy things later on and not have it mess up. So for this first year, my adjustment for deferred taxes will be a credit of $480. And now that I've got that done, steps 1, 2, 3, 4, 5, and 6, I'm ready to do a journal entry. So let's jump right into it. The taxes payable was $32,200. We've got deferred taxes, which are a credit for $80. And we'll use income tax expense as our plug figure. And that's our value. Now, the last thing we want to talk about, I don't want to spend a lot of time on it, but I do want to take just a minute talking about how these numbers would show up in our financial statements. So on the balance sheet, we're going to show deferred tax liability, $480. It has to go in long-term liabilities under the new GAAP rule. And then we'll have income tax payable. It may not be $32,200 because we may have already made some payments. Matter of fact, the IRS requires that you pay out quarterly what you think you're going to owe them. So chances are the company has estimated what this $32,200 would be, and they've already made some payments. So because of that, what we see for most companies is we see a bunch of debits to income tax payable and then a big credit when I actually do my final journal entry for income tax payable for the year, and that balances out to give us the net amount that we still owe the government and will pay on that that April 15th deadline. So that's what we usually see as far as how income tax payable shows up on the balance sheet. What we do want to look at is what would show up on the income statement. Now, hopefully you remember from our last discussion that there are actually 3 pieces of information that have to show up related to taxes on the income statement. We have to show the current amount that we owe, that's this $32,200. We have to show the deferred taxes, that's the $480, and we have to show the income tax expense, that's the $32,680. We can do them on the income statement or put them in the footnotes and just refer to them in the income statement. Either way works. The footnote can be done a million different ways. I can't really show you how that would look, although you can pull up a 10K for a company and find that deferred tax footnote and see all the numbers that are there. What I can show you is how they would look if you chose to put them in the income statement, because that's pretty generic. So let's go ahead and do that. Income before taxes, and that number is up here, so I'll just link to it. And then I would have an income tax expense section, kind of like a cost of goods sold section, and it would start with current taxes. And that would be this number. And since this is money that I owe, it's a negative. It's going to reduce my income. And then I'd have a deferred taxes line. And if it's a deferred tax asset, it would be positive because it's going to reduce what I think my expense should be. If it's a credit, it's going to be negative because it's increasing my income tax. And if I've done this right, when I sum these up, I will get this $32,680 up here. And there it is. That's just what I wanted to see. And the final thing I can do, I can put in my net income, which will be the 100,000 plus that 32,680. There's my net income number for the year. And since I'm old school, I love to see that double underline. I'm going to put that in there so I've got it. Now that wraps up our calculations for year one. We've got the journal entry, we've got the financial statement section, we've talked about the balance sheet, we've got everything we need. What we are going to do next is talk about the year two numbers, but we're going to do that in our next segment. I encourage you to take a few minutes, try it on your own, so that when you come back, you're checking your numbers and just tweaking what you've done. Believe me, it will look much better and work much better for you if you try it and then see where maybe you slipped up or see it done the exact same way you did it. That will reinforce it much better than just following along with what I'm doing. So it's entirely up to you, one way or another. I'll see you in the next segment as we walk through years 2, 3, and 4. See you then. Thanks.